Albert Einstein once said that compound interest is one of the most powerful forces in the world, even stating that it was the eighth wonder of the world. In this video, I'm going to explain to you exactly what compound interest is and why it is such a powerful force in the world of long-term investing. So what is compound interest? The best way to learn is through examples, so let's go ahead and look at an example to understand how compound interest works. Let's say that you have $5,000 to invest, and for the sake of this video, you are investing it into a vehicle that earns a 5% return on an annual basis. That means that on your initial $5,000 investment, after the first year, you will have earned a 5% return on your investment base, which is $5,000. A 5% return on $5,000 is $250. That means at the end of year one, your investment portfolio is now worth $5,250. The next year, your account is going to earn 5% yet again. And now because your investment base is larger at $5,250, in the following year, your account will grow to $5,512.50. Before we move forward, let's analyze what just happened in these first 2 years. The first year, the account was at $5,000 and it earned a 5% return for a total dollar gain of $250. At the end of that first year, your account was worth $5,250, and throughout that next year, your account earned 5% yet again, appreciating to $5,512.50. If you pay attention to the dollar gain here, you'll notice that in the second year, the account appreciated by $262.50 as opposed to $250 in the first year. This occurs because in the first year, when your account was initially $5,000, you earned 5% on the $5,000. But at the end of year one, you had $5,250, and therefore, through the second year, your $5,000 initial investment earns another 5%, but the $250 you earned in year one also earns 5%, and therefore, in the second year, your total dollar gain is higher than it was in year one because your initial investment earned 5%, and then your 5% earnings also earned 5% in the second year, and therefore the interest is said to compound. So as you can imagine, if we continue this process year after year and over a long period of time, the dollar gains in each subsequent year will be larger and larger than the prior year, and that's because the investment base is growing. And if we multiply a larger investment base by the same percentage return, every single year that dollar gain is going to be larger than the previous year because your investment base is growing, and essentially all of the money that you have earned, including your initial investment base, is going to appreciate year after year. To show you the power of this over a long period of time, let's look at a $5,000 initial investment and look at a 5% annual return over a 40-year period. Before I show you the results, if we assume a 5% growth rate over 40 years, let's take 40 years multiplied by 5%, and that gives us a 200% return. We can see that this account goes from $5,000 to just over $35,000 in 40 years. That means the total percentage gain was 504%, which is significantly higher than the straight line calculation I did, which was 40 years multiplied by 5%, which gives us 200% in theory. So the actual return was 504%, but if we just straight lined the percentage annual gain times 40 years, which is the investment period, we get 200%. The reason that the actual gain is much larger is because every single year, the investment base grows from the prior year's earnings, and going forward, those earnings also appreciate, and every single year, as I mentioned earlier, the investment base will grow, and therefore the same percentage return on that larger investment base will yield a larger dollar gain every single year. So how should you use this information as a long-term investor? As a long-term investor, we can't control what returns we get every single year, but we can allow compound interest to work for us, especially over longer periods of time. This means that every chance you get, you should invest more and more money, because the longer you have an investment in a particular product or the general stock market, Doesn't matter what the investment vehicle is. The longer the time period for your investment, the longer you are going to give compound interest to work for you, and therefore, at any chance you get when you have savings, you should invest more and more money, because the larger you can grow your investment base now, the larger that is going to exponentiate over a long period of time. So you shouldn't look at the previous example of investing $5,000 and earning 5% for 40 years and saying, well, I only made $35,000 at the end of that 40-year period, and that's kind of a long time before I made $30,000, so it's not really worth it. The way you should look at it is that every $5,000 that you invest could potentially turn into $30,000 or $35,000 or $100,000 way down the line. The faster that you can grow your initial investment base, the more immense those compound returns are going to be over a long period of time. Let's go over some real market examples so that we can understand historically how investing in risky assets, such as the stock market, has led to compound returns over time. If you had invested in the S&P 500 index, which is the large cap US stock market index and essentially represents the US economy, if you had invested in the S&P 500 in January of 2010 and you held until today, which is April 27th of 2020, you are up about 153% on your initial investment. The period from January 2010 to April 2020 is about 10.31 years, which gives us a compound annual growth rate of 9.42%. So essentially, if I invested $10,000 in January of 2010 and I invested that money into the S&P 500 and held until today, my compound annual growth rate would have been about 9.5%. That means that on average, my account grew 9.5% every single year over that 10.3 year period, giving me a total return over the period of 153%. A common investment statistic that you will see when you are looking at potential investments is the compound annual growth rate, or CAGR. The compound annual growth rate essentially takes the ending value and divides it by the initial value, and it calculates a straight line annual growth rate to get from point A to point B. So before I said that over the 10-year period, starting from January 2010 until April 2020, the overall return was 153%. The fixed percentage annual increase that gives us a 153% return over a 10.3 year investment period is 9.42%. If you had invested in the S&P 500 in January of 1990 and held until today, which is April 27th, 2020, you would be up about 697% on every single dollar that you've invested. That compound annual growth rate would be about 7% since 1990. Now, when it comes to investing in the stock market, returns from year to year will be volatile, and it's definitely not a straight line scenario. But over a long investment time frame, especially multiple decades, you have a higher probability of making money on your investments, historically speaking, and you also give compound interest more time to work for you. And in this video, I hope I've showed you how immense that power can be.